Ryan, Neil Kashkari is not a voting member this year, and yet his comments seem to have had huge sway. The market just completely fell out of bed afterwards.
Absolutely, because markets today, they're pretty much out of breath or momentum. It was driven by momentum until now, and now they're looking for direction. Unfortunately, the Fed members, Mr. Kashkari and others, are giving much more information than they should. They said we're data dependent. Let them be data dependent. Let's stop speculating. They should stop speculating. We will cut, we will not cut, 3, 4. This is harming markets. This is harming the U.S. economy. So
there's too much Fed speak. We'll have more later on. We're going to hear from 3 more Fed speakers today. But I'm just curious, if markets are so eager to believe that there may not be cuts this year, then why aren't they pricing that in? Why do they need Neil Kashkari to say, and by the way, if inflation keeps holding up, you know, we're not going to cut?
Oh, markets are still factoring in that there will be cuts this year. They're factoring on a soft landing where we're going to get at least 3 cuts in the second half of the year. This is the tune at the moment. But again, markets today, they're out of momentum, and they are looking for that momentum.
We have jobs data coming out of the United States later on, and the consensus number is 214,000. The whisper number, though, is more like 233,000. What kind of a number does this market want? A good number or, you know, a bad number?
Wow. That's a very wide question. So basically what's happening today is 2 opposing forces. The first one is fiscal spending. Fiscal spending is astronomical, and this is boosting jobs. So we're seeing lots of private companies letting go of employees, but they're being offset by government employees. So this is why jobs have been actually very good. So the markets would like to see jobs bad, because this is what will basically lead to a cut, and this is what markets are looking for, rate cuts. So as long as fiscal spending is happening and jobs are being boosted by these government jobs that are offsetting private job cuts, I think the economy will remain strong. But there are so many government employees you can hire to offset the private sector layoffs.
Speaking of cuts, it's a problem for other central banks that the Fed hasn't cut yet, and the outlook is a little bit murky right now. We're awaiting the RBI decision. Do they stay on hold?
I think they will stay on hold, and I think they should stay on hold as an economist, because basically inflation is still around 5%, above 5%. India's economy's GDP is 70% consumption. Inflation hurts consumption, so they need to control that inflation. However, general elections is coming up, so a rate cut would be welcomed by stock markets. So this is where it's a bit tricky. But I think 90% they will hold, they will not cut for now.
You're invested in India. You're also now selectively going into China. It's a theme this week, all of a sudden, that maybe the pivot is actually happening and that China is becoming attractive again. Where are you investing?
So we are going in multiple sectors, very well diversified, being stock pickers, because basically the Chinese government did not do a full support as they do usually. They've been very selective in the way they're supporting the economy. Industrial production is going up again. Demand is going up again. So we do believe China has bottomed out, and there are some amazing bargains to pick up. If you look at the world map with overvaluation in the US, Europe is starting to be a bit overvalued with the stocks index at 22 PE. Japan as well, things are changing. So China today is the best entry point for us.
Where are those pockets of opportunity, though? I presume you're not talking about real estate or anything associated.
Absolutely not. So one example is electric vehicles. So today, China is coming in quite hot with electric vehicles. They are basically becoming price setters with regards to EVs. So that's a sector we really believe in China. Now, that's a risk to Europe. So we do believe that Europe will introduce some tariffs or some to hinder the potential imports of Chinese EVs. But it's a sector that we would bet in China.
And indeed, we saw orders for BYD blow away estimates in the first 24 hours. So I can see your argument there. You're also invested in India. And there was maybe talk percolating through the markets this week that perhaps India's gains are done, particularly with the election coming up, and maybe the gains are priced in for any kind of a result. Where are you still invested in India?
So again, we're quite diversified across the board. So China, 70% of its GDP is consumption. Now we're betting on manufacturing. So this is the next, I think, evolution of India, becoming the new China. So we believe that India is what China was 15 years ago. So it's for China's GDP to transforming from 70% consumption very similar to the US is, into manufacturing. And this is where things are transforming. So we are betting on manufacturing companies, manufacturing to start to move from China to India and from other parts in the world into India.